I want to welcome everybody to Keep More Commissions with Tax Breaks, and we're talking about a lot more. But I'm also honored to be speaking to you, self-employed individuals. I mean, heck, my parents were self-employed. I'm self-employed. So I really admire that entrepreneurial mentality of wanting to take some risks in order to make a lot of money. I'm going to be covering a number of things. This is sort of a 30,000-foot overview of what's in my books and my videos. So you're going to want to get a pen, you want to get some paper, because I am really going to move. The good news is that this is going to be recorded, so you'll be able to hear it again. Now, I'm also going to be saying some shocking things that are really going to surprise you. And I'm going to have a number of questions to ask of you. And one of the first questions is, have you ever had a situation where you were charged more than what you expected on your credit card? Maybe you were charged for something you never even bought. You ever have that happen to you? It happened to me. I went out to dinner with my wife, and I got a bill for about $100. And the bill was not only $100, but it was twice charged for the same restaurant. I was irate. I called up that credit card company, and I immediately demanded a refund. Now, here's my question to you. When that happened to you, did you just let it go and just simply pay the $100 or $200 in this case? Or did you demand a refund? And how did you feel when that happened? Well, I want you to hold on to that feeling, because I'm about to make it a lot worse. What if I were to tell you that you're overpaying your taxes to the tune of thousands, not $100 like a credit card overpayment, but thousands? Would you want to know about it? Of course you would. Well, here's an interesting factoid. You're going to spend more on taxes than you'll spend on food, housing, transportation, and clothing combined. Well, the good news is I'm going to show you that there's an easy solution to help prevent your overpaying your taxes and give you that peace of mind of never having to worry about an audit again, because your records will be in great shape. Imagine this, increasing your deductions and reducing your chance of audit, as strange as that sounds. Now, I want to go over a little bit about who I am and why I'm qualified to teach you, because I am going to be saying some surprising and I think shocking things. First of all, my name is Sandy Botkin. I'm a CPA. I'm a tax attorney. I'm a former trainer of IRS attorneys nationwide. So if you think of an IRS agent as a rat, I guess that makes me head rodents. I've also been lecturing for over a quarter of a century with my company called the Tax Reduction Institute on tax and financial matters. I have been a featured tax coach with Donald Trump at the Tony Robbins Wealth Seminars. I'm a best-selling author. I'm a best-selling author of 2 books. The first one is called Lower Your Taxes Big Time. And the second one, which is garnering some terrific reviews, is Achieve Financial Freedom Big Time. And both Lower Your Taxes Big Time and Achieve Financial Freedom Big Time are available on Amazon and Barnes & Noble and so on. We don't sell it here, but it is available. And I've been a guest expert on a number of media, from Fox, CNN, CBS, and CNBC. And I'm not saying this to impress you. I just want you to know that what I'm going to say, I know what I'm talking about. Now, here's the first shocking thing. There was a study done by a major university, and I think it was Harvard, but I'm not sure. It was about a 10-year-old study, and the question they asked is, what percentage of the population can retire at age 65 with the same standard of living they had before retirement? The question wasn't shocking, it was the answer. The answer was 4%. 4% of everybody interviewed on this long-term study was able to retire at age 65 with the same standard of living. That means 96% of Americans and Canadians had to either continue working, live on some form of charity, or reduce their standard of living. And that was a 10-year-old study. That was during a time when people gave pensions. I was just reading that only 20% of companies today give a pension, which means that that number is much worse. How would you like to be in that top 4%? If you listen to me, I promise I will get you there. Because here's the good news. We're going to change all that today. We're going to be discussing some amazing tax breaks that I'll bet you didn't know about, and talk about what exact records, the meticulous records you need to never have to worry about an audit again, because your records will be in great shape. Now, there's a current tax dilemma that I have found by lecturing to over 30 years. And what I found was that most people either are not taking the deductions they should be taking, or they're taking more in deductions, but they don't have the right documentation. It's usually one of those two, and they're risking a tremendous amount of penalties. They're rolling the dice. Even worse, when you're self-employed, you have a 700% more likely chance of being selected for an audit. In fact, in both the U.S. and Canada, they want to hire thousands of new agents to overcome the problem caused by the budget freezes. So that's even more scary. And in both countries, you are guilty until you prove your innocence. And that's the important point. You have the burden of proof. In fact, I'm going to say something that's going to sound kind of funny. The government is the biggest bookie in North America. The reason is that they're betting on you big time to succeed in your small business, because the government knows from little acorns come big trees. For example, Apple Computer didn't start with 200,000 employees. It started out of Steve Jobs and Steve Wozniak's garage. Amazon, the big giant, started out of a garage. Okay, Microsoft didn't start big; it started small. So the government knows that by subsidizing small business, they can create jobs. In fact, the government wants you to be in business, and for that reason, there are two tax systems in both U.S. and Canada, by the way. And when I say there's two tax systems, I always have people say to me, "Oh, sure, Sandy, one for poor and one for rich." That's not quite true. It's close. There's one to make you poor, and there's one to make you rich. The one to make you poor is designed for employees, because if you are an employee, you are taxed on $1, and you don't get that many deductions, despite what you may think. And if you do get an employee business expense in both U.S. and Canada, it has to exceed a certain threshold. In fact, in the United States, if you take too many of them, then it gets disallowed, and there's something called alternative minimum tax. But if you want to take advantage of the system that makes you rich, that's for self-employed individuals. Because if you're self-employed, you can write up out of your house, your spouse, the equivalent of your kids' education and weddings. I'm not exaggerating when I say that. You can set up a pension plan that makes any government plan look small by comparison. You are taxed on your net income, not from $1, but you get to take all your deductions where the government gets one dime to drink. There's no threshold you have to exceed. I mean, the benefits of being self-employed are enormous. And for this reason, the government creates good tax laws, and there are good tax laws that will generate cash that you never have to pay back. Think about this. This is effectively free government funding for your business if you know what you're doing. Now, Mary is a good example. Mary is an employee, or she could be self-employed who doesn't know the rules. Same problem. She has the following expenses. Cell phone. Now, a cell phone as an employee is normally not deductible. She has mortgage interest, which is normally deductible in the U.S., but it's not deductible in Canada. She might pay rent, which is not deductible in both countries. She drives to work. She has gas, repairs, insurance, things like that, not deductible. Mary likes to eat out a lot, not deductible as an employee. She likes to entertain. She has movies and goes to play golf, not deductible. Medical expenses. In both countries, you have to exceed a high threshold. In the U.S., it's even higher as a result of Obamacare. And she has other expenses, which are not deductible unless they exceed a high threshold. But here's my point. The same expenses, a portion of these, can now become partly deductible by taking advantage of the good tax laws, by having a small business and knowing what you're doing. We call these rules redirected tax dollars. Now, here's my point. Imagine paying $8,000 or $10,000 or $12,000 or even more to the IRS or Canada Revenue Agency, or taking a good portion of that money and using it to subsidize your business and paying less to the government. Which do you think is the wiser move? You think that maybe many millions of money-smart people are now starting home-based business for this reason? Believe it or not, you have a choice. The choice is by proper tax planning, you can take a good portion of what you would normally give the government and keep that money and use it to subsidize your business. In fact, here's something that's really interesting, and I'll bet you're never going to guess this. And who are the biggest tax cheats in North America? Do you know? Because the answer is going to shock you. Here's the answer. Business owners themselves cheat themselves out of billions in lost deductions. In fact, I estimate that small business owners overpay their taxes to the tune of, get this, $150 billion, that's with a B, $1 billion a year. And even worse, 95% or more of those people didn't think they overpay. Imagine that. Now, why is that? There's two reasons. One, lack of knowledge. You don't know what you don't know. But the second reason is procrastination. You know, it's kind of like an alarm clock. If you don't set your alarm, you don't wake up in the morning. You may not go to your appointment. You may not be there on time. If you don't have something triggering you in tax law to do the certain things you need to do, such as your mileage log, entertainment questions, travel questions, all the things I'm going to get to today, You won't have the right documentation, so your records won't be right. That's the problem. It's usually one of those two issues. Now, there are a number of cash drain myths that cause people to lose a tremendous amount of money, but there's one that stands out. It's only 7 words long, and yet it causes more people to lose money than almost any single financial mistake you can ever make. And those 7 words are, my accountant takes care of my taxes. I have a similar myth, by the way. My spouse takes care of my taxes. If you learn anything, learn that. I equate this with a doctor taking care of our body. Wouldn't it be great if we can eat all the cholesterol and all the fattening foods, and once a year we go to a doctor's office and we get one of these Roto-Rooter jobs? Wouldn't that be nice? Another big myth, my mechanic takes care of my car. Those of you who have ever owned an older Jaguar would appreciate that myth. But the point is, accountants are essential for small business people. I absolutely cannot understand why anyone would do their own taxes. But here's the problem. If you don't have the right documentation, there's only so much your accountant can do for you. It's got to be a partnership effort. Does that make sense? Now, here's another major myth. I used to give these big major seminars with Donald Trump and General Schwarzkopf when he was alive and others, and I had a gentleman come up to me and said, Mr. Botkin, I loved your program. There's only one problem. I don't pay taxes. I get a refund every year. Imagine, he didn't realize he was getting back his own money. I had several people say that to me. They're thinking they didn't pay much in taxes, so I ran the numbers. And I just chose an average tax state. I didn't take the highest tax states, which right now are California, New York, and Hawaii. I just took an average one. Someone who makes $50,000 a year of net taxable income, that's net of all their deductions and their exemptions and so on, pays roughly, in an average tax state, $12,917 in taxes. Now, their withholding or estimated tax is usually more than what they would pay. And the reason is, 1, the government wants to make sure they get their money, but 2, if you get a refund, don't you feel better? Just like these people who thought they weren't paying taxes. So even though this person is getting back a $1,568 refund, they're still leaving some of that with the government. They're still leaving $12,917. See that? This translates to 25.8% of their net taxable income is being paid in taxes. And by the way, we're not talking about Donald Trump here. We're talking about a hardworking single person netting out $50,000 a year. Now, somebody making $100,000 of net taxable income pays 32.4% of what they make in taxes, and somebody who makes $250,000 a year pays 37.7% of what they're making in taxes. So my point is, you are paying taxes, and you're paying a lot of it. Now, here's another myth. What if I have a home-based business? How is that different than, say, what a Fortune 500 company can provide for their employees or a brick-and-mortar business can provide for their employees? Answer, none. You get the exact same tax advantages that a Fortune 500 company can provide their own employees. I mean, in my book, Lower Your Taxes Big Time, which I recommend to everyone, I have 130 pages on fringe benefits. Almost every single page, almost every single fringe benefit applies to home-based businesses, just the way it would apply to, say, IBM for their own employees. Same thing. Most self-employed people really don't realize that. Here's another big myth. I only work my business part-time. I'm not working it full-time. What kind of tax benefits do I get? Answer, you get the exact same tax advantages whether you work your business full-time or part-time. Now, here's one of the biggest myths. I'm not making any money yet, or, I'll wait till I make $200,000 before I worry about tax planning. I want you to write down something. Take that pen and paper, and I want you to write down that the amount of income you make is immaterial for tax planning to benefit you. The amount of income you make is immaterial for tax planning to benefit you. And here's the reason. There's actually 3 reasons. Remember I said the government is the biggest bookie in North America? They subsidize you in 3 different ways. The first way they subsidize you is that if your business generates a loss, that loss can be used against any form of income you have in both the U.S. and Canada. Interest, dividends, wages, rents, pensions, anything. So let's take an example. Let's say you're making $50,000 a year in a job. Your side business generates a $10,000 loss. What you pay taxes on is the net, the $40,000. Now, let's say that loss exceeds your whole income for the year. Here's the second way they subsidize you. You can carry back all business losses in the U.S. 2 years and get a refund from the federal and state government for the last 2 years of taxes that you pay. You actually get a check. You get to offset all the income you had in the last 2 years. For those Canadians on the line, you get to carry it back 3 years. You actually have a better deal. And the third way they subsidize you is once you carry back all your losses, you can then carry forward all business losses in both U.S. and Canada up to 20 years and offset the next 20 years of earnings. So you never lose a properly documented, reasonable deduction. The key is you got to run your business like a business and not like a hobby, and then you can deduct all of the necessary and ordinary expenses in your business. Now, here's another interesting question. What if I were to offer you a choice? I were to give you a $17,000 raise every single year for 10 years. You actually get a check from me every year for 10 years. Or, but except it'll be fully taxable, by the way. Or, I'm going to somehow wave my magic wand and save you $10,000 in taxes every year for the next 10 years. Which would you pick? Probably pick the $10,000 taxes because you know this is about taxes. But believe it or not, that would be the right answer. Because by the time you pay tax on the $17,000 federal, state, and Social Security, or federal, CPP, and provincial, you're left with less than $10,000. You know, a lot of people don't necessarily translate deductions as to a raise or saving money, but it really is. Here's a good example. Someone who makes $18,000 a year, if they're in the 40% tax bracket, okay, which means they get to keep 60% of what's left over, 60% of $18,000 is roughly about a little over $10,000, about $11,000 in net in their pocket. That is the same thing, same after-tax benefit of someone who makes $1,000 a month gross and then has to pay tax on that. Same after-tax money. Now, here's something interesting. I just paid, I think, $3.49 in gas. How would you like to get the equivalent of free gas? Seriously. You know, by writing off your car, that's exactly what you get. And there are two ways of writing off a car in the U.S. One is what we call the mileage rate, the IRS mileage rates, and the other is the actual method. Canada, you only can have the actual. The IRS is the more conservative approach. So we're going to use that to show you how to get free gas. So it's definitely more conservative. In 2014, IRS gives you 56 cents a mile for every mile you drive for business. And by the way, who has the burden of showing that we drove so many miles for business? Does the government or do we do? And the answer is we do. And how do we do it? From our tax tracker or tax organizer. Now, they also give you 23.5 cents a mile for medical and moving. Every time you go to the doctor, every time you take your kids to the dentist, you should be claiming 23.5 cents a mile round trip. If you're not doing it, you're overpaying your taxes. Now, in both you and the United States, IRS gives you 14 cents a mile for charity. So I have a friend of mine who is on his board of directors of his alumni association. He should be claiming 14 cents a mile round trip. You think he's doing it? No. In my neighborhood, a lot of moms drive their daughters to sell Girl Scout cookies. Those moms should be claiming 14 cents a mile. You think those moms are doing it? Heck no. And they're overpaying their taxes. Now, how do you get gas for the equivalent of free? Watch this. Let's say tomorrow you drive 20 miles for your business. IRS gives you a 56 cent a mile deduction, so your total deduction is 20 times 56, or $11.20 deduction. Now, a deduction is not cash. The amount of cash you get from a deduction is your whatever tax bracket you're in times the deduction. And by the way, tax bracket, I really should explain what this is. This is not the average of what you pay. Tax bracket means what you pay on the last dollar you make to the federal and state government, or federal and provincial government. And then United States, that includes federal, state, Social Security, and Medicare. The average American is in the 33% tax bracket. It's a little higher in Canada, but the average is 33%. It could be as high as 53, by the way, but the average is 33. So let's put it like this. Let's say you're in the 33% tax bracket. You generate an $11.20 deduction from driving those 20 miles. That results in a $3.69 cash savings in your pocket on that $11.20 deduction. Now, my point is this. If gas costs $3.50 a gallon and you get 20 miles to the gallon, not only is gas free, but you're actually making 19 cents a gallon profit. Everybody see that? And that's the IRS method, which is the more conservative approach. Now, the actual method is where you take a percentage of your various automobile expenses like gas, oil, insurance, wash, wax, depreciation. So let's say you put on 40,000 miles totally for the year. You have 20,000 of those for business. Therefore, 50% of each of these expenses are deductible. Now, I do want to mention something. The IRS method is in lieu of your gas, oil, repairs, insurance, wash, wax, depreciation. But there are a couple things you get in addition to the IRS method. You can deduct the business portion of any sales tax you pay and the business portion of any interest on car loans. And that also includes tolls and parking for business. Many accountants were not aware of this. So if you filed, especially the IRS method, and you feel your accountant did not deduct a portion of the sales tax or the interest, I want you to file amended tax returns for the last 3 years you've been in business, federal and state returns, to get back taxes. In fact, I know someone who did that, and he got back over $6,000. This is not a small number, by the way. Taking a deduction for some of those sales tax and interest as a business expense is a big deal. Now, what kinds of documentation do you need? First of all, you need an odometer log for your beginning and end year's odometer reading, regardless of the method you use. You also need a mileage journal showing the mileage, or in Canada, the kilometers, for each trip you take. You might wonder, well, why do I need an odometer log and a mileage journal if I use the IRS method? Because you got to prove how many miles were for business in order to multiply that 56 cents a mile. In addition, and this is something that a lot of self-employed people are missing, you must have an explanation of the business purpose for each trip you take. And most self-employed people, I think, are missing that. That's a big deal. If you don't have it, you don't get the deduction. It's that simple. Now, here's a hot tip that a lot of us accountants use. Let's say you go to your mom, or you're doing something personal, taking your kids to football games or to tutoring. Now, that's normally not deductible. Well, you know, there's an old saying in Washington, D.C., where I live, where there's a will, there's a lawyer. And the point is, what I ask myself is, do I have a business stop near the personal stop? So if I might say, do you have an opportunity meeting near where you're going personally? Or do you have a prospect or a client or a potential distributor or a distributor where your mom lives, near your mom? By doing that, a substantial part of that trip to see your mom would be deductible. And by the way, here's the important point. Your mom doesn't have to live near you. Let's say your mom lives in Hawaii or in Vancouver. You can transfer to you can go to those cities, put ads in the paper looking for distributors, and by doing that, now you can deduct that trip of going to those cities, even though you're also seeing your mom. You just have to document it correctly in accordance with our videos. Now, let's talk about cars and trucks. In the United States, if you buy a qualifying truck, new or used, or a SUV, new or used, you can elect, here's something I bet you didn't know, to write off up to $25,000 of the business use of those vehicles. So that's in addition to depreciating the vehicle. So what's a qualifying truck? A qualifying truck is one that has a gross vehicle weight, which means carrying weight of over 6,000 pounds, has a truck chassis. It has to have at least a 6-foot cargo area, and it has to have room for the driver and only one passenger sitting next to the driver, period. No rear seating. If it has a rear seating, if it has room for passengers, then you come under the SUV rules. You're a sports utility vehicle. Well, regardless of whether you're a new or used sports utility vehicle, new or used qualifying truck, if you meet these rules, you can elect to write off $25,000 in 2014 of the business use of that vehicle, and then depreciate what's left over. Those are your two winners, trucks and SUVs. You might wonder why you're seeing so many on the road, and that's the reason. All right, here's another big tip. You're allowed in both the U.S. and Canada to deduct 50% of your meals as well as 50% of your friends' meals for anyone who's a potential prospect or client for your business. Here's my question. Who are your potential prospects? Are your best friends potential prospects? Maybe distributors or give you referrals? Sure. How about your adult family members? Sure. How about your next-door neighbor? Absolutely. I've never met two home-based business owners or two networkers get together and not talk business. So here's the question that I asked a former commissioner of IRS. If everyone is a prospect, how can you ever have a non-deductible lunch? You can't. And if you're picking up the bill, if you're paying part of that bill, and you're not deducting that, you are leaving money on the table. You are overpaying your taxes. And I have people, so everyone is a prospect. And what kinds of documentation do you need? First of all, you got to have what I call the 4 W's and an H written in your tax diary or tax organizer. Who? What's their name? In this case, John Smith. What was discussed? Asked for referrals. Where? Went to Chili's. Or if I were in Canada, I would say went to Tim Hortons, probably go there for breakfast. When? The date. And finally, how much? Who, what, where, when, how much? If you do this in your tax organizer or tax diary, you will never have to worry about an IRS or Canada revenue agent audit again. The rules are the same in both countries. By the way, I want to emphasize how important a tax tracker is or a tax organizer. All of you have homeowners insurance, do you not? Why? Because if your house burns down and you don't have it, it's a disaster. You probably have car insurance. Why do you have that? You don't use that all the time. If you did, you'd be suspended because you get into an accident and you don't have it, it's a disaster. Your tax tracker is your audit insurance against the government. It keeps the government off your back. You want to know how to do it? That's how you do it. It's like homeowners or audit insurance and auto insurance, but the only difference is it is your audit insurance, and you can use it every single year, and it will save you thousands. And you never can get canceled. It is absolutely essential. And people ask me all the time. They said, Mr. Bott, can you mean to tell me the IRS will believe everything I say in my tax tracker? Yep. Unless they can show fraud, they will believe by regulation everything you say in your tax tracker. That is your audit insurance against IRS. Knowledge is the premium for the policy. Between knowledge and documentation, you'll never have to worry about an audit again. You will be bulletproof if you do get audited. And by the way, I have people ask me all the time, they say, wait a minute, Sandy, doesn't entertaining trigger an audit? And the answer is no. In fact, in both U.S. and Canada, you are encouraged to entertain. You see all these ads on the Super Bowl and on the Olympics and all these other TV shows. Now, I think you'll agree with me that many of these companies that advertise, they know that not every person is going to buy their product who sees the product. They know that. Well, small business doesn't advertise on the Olympics, but their form of advertising is viral marketing or word-of-mouth advertising. So the government actually encourages you to advertise in the code, and they do this for two reasons. One, you are promoting your business in pursuit of a profit, and two, you're offering proof that you're running your business like a business. So advertising, entertaining is encouraged in both the U.S. Internal Revenue Code and in the Parliamentary Code. Now, in addition, there's something in both codes called associated entertainment, which I bet you never heard of. I want you to write down the word associated entertainment, and I want you to put an equal sign and write down the word fun. Fun. This is where you're going to the movies. This is where you're playing golf. This is where you're going to a play. This is where you're going to a football game, and you're deducting that fund, so you're having twice as much fun. In both U.S. and Canada, IRS allows you to write off, and Canada Revenue Agency allows you to write off 50% of your fund as well as 50% of your friend's fund if, quote unquote, this is not Sandy Botkin talking, this is IRS or Canada Revenue Agency talking, if you talk business within the same 24-hour day as the fund. Does that give you enough time? So let's take an example. Let's say I were to talk with Jake, and we go to his house and we talk business. And then we drive to a football game. Is that talking business within the same 24-hour day as the business discussion? Yes. We talked business in the house, and then we went out to talk business. Now, number two, what do we do? Let's say we were to go have lunch. And then Jake says, Sandy, it's such a beautiful day. What do you say we go play golf? And I'll tell him, okay, you show me how to play, I'll go with you. I might have a 300 handicap, but I'm going. Is that talking business within the same 24-hour day? Answer, yes. That's the bottom line. Here's the point. Who has the burden of proof of showing that we talk business during the same day? Does the government or do we do? And the answer is we do. And how do we do it? From our tax tracker or tax organizer. And again, what kinds of documentation do you need? The 4 W's and an H in a tax tracker. Who, what, where, when, how much. It's that simple. Now let's talk about a home office. I will bet you that you heard that if you claim a home office, it isn't worth it, and you're probably going to get audited. Well, I'm here to tell you that if you have a home-based business and you're not claiming a home office deduction, and you're eligible, which most of you are crazy because you are overpaying your taxes to the tune of thousands. In fact, let me give you an overview of how the home office works. What you see here is a floor plan, typical floor plan, and I'm going to assume you use 1 bedroom for business, and I'm also going to assume that that bedroom represents 1/8 of your total square feet. Now, in your house, it could be a little more, a little less. I'm just picking a number. Now, what does that mean, though, 1/8 used for business? Well, that means 1/8 of the utilities now become deductible. Before, you couldn't write off those utilities, but now you can. That's an example of redirected taxes. 1/8 of the interest becomes business interest, and this is particularly important in Canada because you Canadians can't write off interest in Canada, but by having a home office, you can. 1/8 of the property taxes now become business taxes and are deductible. 1/8 of the house can be depreciated. Now, that is worth thousands. Now, for you Canadians, you normally don't pay tax when you sell your home, but there's a special rule that says if you claim a home office, then the portion that you claim as a home office, you'd have to pay tax on. So if 1/8 of the house is a home office, 1/8 of the gain you'd have to pay tax on, unless you don't take depreciation. You have the option in Canada to not take depreciation, and therefore, when you sell that home, not pay tax. That's not true in the United States, but that is true in Canada, so be aware of that. A lot of times people ask me, what happens if I rent an apartment? Can I still claim a home office? Yes. 1/8 of the rent is deductible, 1/8 of the maid service, the alarm service, 1/8 of the snow removal, 1/8 of the lawn care. I mean, this insurance, this is a big deal. It's worth a lot of money. So how do we claim a home office deduction? There are 3 qualifying rules. Rule number 1 is you've got to use an exclusive portion of a room for business. The question is, how do you prove that? I bet you don't know. Here's the answer. Once a year, take a picture of the home office deduction. Date the photograph. But whatever you do, don't send the picture in with your tax return. Keep it in case you get audited. When I was working at IRS, somebody sent the photograph in. I guess he couldn't help himself. He was making some undesirable hand and arm gestures. I thought it was funny, but not everyone at the government has a sense of humor. So you want to take a photograph of the home office deduction, photograph all the furniture, photograph of everything there in the home office, date it, but keep it in case you get audited. Number 2, you've got to use your room regularly for business. Now, what does that mean? That means at least 45 minutes a day, 4 to 5 days a week. Now, obviously, it can be more than that, but at least 45 minutes a day, 4 to 5 days a week. And how does the government know you're doing this? They look at your appointment book or your tax tracker. And finally, you've got to use your home as your principal place of business. Now, what does that mean? That means you do the majority of your management or administrative work from your home office, and you don't have another office where you do any significant administrative work, which should be easy for all of you. So the bottom line, by meeting these 3 rules, you now can claim a home office deduction quite legally and put thousands in your pocket. So thank me, I'm about to give you the equivalent of that $1,000 a month raise. By the way, here's one big question. A lot of accountants tell you to save up for your kids' college education and weddings. But, a lot of times people ask me, can I deduct my college education for my kids? And the answer is no. How about a wedding for my daughter? No. How about room and board? No. How about a car? No. Despite what I said, how would you like to be able to deduct the equivalent of every single thing I just said? Would you like it? You're going to like this. I think it's going to pay for your time easily. I've always said in tax law, you get one idea, it is worth thousands. In fact, we had a reviewer who reviewed some things that we did and said the same thing. Here's how you do it. I'll show you what I did. Hire your kids. Hire them in your business. If you were to pay them a reasonable wage in business, and they use that money to pay for their own college down the road, or their own wedding down the road, or their own car, or own video games, aren't you in essence getting a deduction for those things? It's the same money, but in one case you're taking a deduction as wages, not as tuition. Same money. Now, how much can you pay the kids? In the U.S., it's up to $6,200 with no income tax because they get a standard deduction on their own tax return of $6,200. That's in addition to claiming that as an exemption. In Canada, it's a lot more. It's over $10,000. So it's tremendous. In fact, give you an idea of what I did and show you how valuable this is. My daughter majored in digital design, which is sort of like web design plus emotion. After 2 years, my daughter was able to do internships, so she had sufficient skills. I wanted to have a new designed website. Now, I didn't want to use these other free sites because they were garbage. So I contacted a major firm to develop a site for me with all the bells and whistles, and it was a high price. So I called up my daughter and I said, wait a minute, can you do my site for something less? Which she did, and that made it reasonable. I was able to pay my daughter the equivalent of about 2 years of tuition, 2 years of room and board, plus books. I was able to save tens of thousands of dollars by hiring my daughter in my business. And if you haven't done that, you are overpaying your taxes by a fortune. You really are. Again, remember I said there's a current tax dilemma. You're either not taking all the deductions you're entitled to, or you're taking more in deductions, still not all, but you're taking more, but you don't have the right documentation. That's the dilemma. And by the way, here's the sad spot. I'm only covering maybe 3 or 4% of what's available to you. Just imagine how much is available to you. It's just enormous. Hopefully, I have convinced you of the horrible mistake of overpaying your taxes and the need to start keeping meticulous records, and of course, to learn more about tax deductions. And by the way, a lot of people think, well, what about credit card statements? Won't they work? I can tell you that IRS agents and Canada revenue agents love people who think that way. They really do. Well, think again, because you need more information than the credit card provides, because in tax law, you have the burden of proof of your deductions, and they were all business-related, and you're following the rules. Remember, you have that burden, not the IRS. And how do you meet that burden? A tax tracker or tax organizer. And by the way, remember I talked about getting redirected tax income, being able to deduct things you weren't able to deduct before? The key to getting this is you have to meet a certain code of conduct. First of all, you've got to run your business like a business and not like a hobby. See, the government, in order to subsidize you, they want to make sure you're a good bet. So they want to make sure you're really trying to make money. Now, what does that mean? Well, I have a whole video on this, but let me give you an overview. Business people, first of all, if they're not making money, what do? They contact successful people to find out what they need to do to turn their business around, experts. Business people go to training like this, whereas hobbies do not. Business people work their business regularly. And again, that usually means at least 45 minutes to an hour a day, 4 to 5 days a week. Hobbies, on the other hand, might do it once every 2 weeks for 12 hours. If business people always have accountants to go over to develop financial statements for them. So if they're not making money, the accountant can suggest where they can cut back. Business people have good documentation. They have tax trackers and tax organizers. Hobbies do not. That's a very important factor in determining whether you're a business. Again, the government doesn't care if you're making money. I know that sounds funny. They don't. All they care about is you're tracking your expenses in accordance with IRS and Canada Revenue Agent standards for your business. You're trying to make money. That's the important point. And don't forget, you have a 700% chance of being selected for an audit. You know, that's a very important point. In fact, when you sign your tax return, right below the signature page are little itty-bitty words that say we solemnly certify under penalties of perjury that the foregoing return and accompanying schedules are true and correct to the best of our knowledge. When you sign that tax return, you are making that promise to the government. And if you violate that promise by not having the right documentation, well, their answer is fine. Their end of the deal is also violated. They can cancel your deductions and hit you with penalties. It's that simple. Let me ask you a question. How would you like to have a personal tax assistant? Because you're very busy trying to build your business. So how would you like to have a personal tax assistant to be able to do all of this for you, keep your mileage logs for you, keep all your receipts in a safe way so that even a flood wouldn't hurt them, keep all your tax diary and tax tracker and all your notes so you're bulletproof from the government? And would you like that even better if instead of paying them minimum wage, and they just raised the minimum wage here in the United States, you only paid them pennies, cents per day, not per hour, per day? Would you be willing to do that? Let me introduce you to the best tax assistant, and probably one of the most least expensive tax assistant you'll ever see, and that is TaxBOT. TaxBOT is a cute creature, looks like this. It has a 4.5-star rating in the App Store. What's great about TaxBOT is 100% IRS and Canada Revenue Agent compliance. What it'll do is you snap pictures of the receipts, you answer simple questions which ensure 100% compliance. Now, I can't speak for you, but I'm not a computer expert. When I grew up with slide rules, so I wanted to design something for me that was simple. You know, one thing I've learned, I am not a documentation nut, but you know, one thing I can do is simple and easy and fast. That I can do. And I designed TaxBOT with 2 buttons. Button 1 is add expense. Button 2, add trip for mileage. That's it. I figure I can figure out 2 buttons. So let's take an example. Let's say I'm going to have an expense. I click on add expense. The minute I do that, I get a whole category of expenses, all of which, by the way, are editable and customizable. Now, the minute I do that, let's say I'm going to have a meal. The minute I click on meals, all the tax questions that IRS requires, notice right here, right on the iPhone or Droid, which shows you what, how much, what was the business purpose, where, when, who. And all those 6 questions are answered, and you will never have to worry about a business, about an audit again. By the way, I want you to notice something. There's a separate line for entity. TaxBOT works on up to 3 different businesses and 3 different cars simultaneously. So you can have, with one account, you can use TaxBOT for you, one for your spouse, one for your kids. It works on 3 businesses and 3 cars. And all the tax questions pop up for all the different types of expenses. And by the way, the second thing TaxBOT has is an integrated camera. So you'll do attach receipt. You'll take a picture of the receipt, so if you have those receipts that fade, you don't have to worry about it. Now you click on save, and all the receipt and the documentation is wirelessly transmitted to the web, so you don't lose your documentation even if you lose your phone. And IRS and Canada Revenue Agency just announced that they now accept digital documentation. Digital records are fine. So it's all 100% compliant. Now, in addition to the expense tracking, in addition to having an integrated camera, it has an integrated mileage tracker with a GPS system. So what you would do is you would click on Add Mileage. The minute you do that, you'll see a little map that looks like this in the middle. You click on Start Mileage Tracking. Now you'll see a little pin following you. The minute you get to your business destination, you click on Stop Mileage Tracking. What happens? The mileage will automatically be put on your smartphone, or if you're in Canada, it'll be kilometers. The beginning address will automatically be put on your smartphone. The ending address, the date, it'll even do this round trip. There's an option for you to do that, or you can disable it. All you type in is why. You then click Save. This will all be put into the web. It'll be summarized for you, and then you'll be able to download a report to your hard drive, which you can email to your accountant, and a percentage. It automatically computes a percentage of business versus personal mileage for you. This is all automatic. Can't get simpler than that. So you can forget about those mileage clipboards. Now you'll notice in the front of TaxBOT, you'll see it'll actually show an estimate of your total deductions to motivate you. In fact, in this example, this is a picture of an iPhone of my partner who generated $15,000, almost $69 as of August 20th. What is that, $1,800 a month? I mean, imagine that. If someone's generating this amount, you think they're going to quit? And that's the important point. You will reduce attrition. Many of the top leaders are getting everyone on their downline into TaxBOT, which is reducing attrition. I mean, who's going to quit when they're generating $1,800 in deductions? This is exactly what it costs you if you do quit. TaxBOT also will look for missed deductions, and they'll actually check out things that you charge on your credit card and or bank accounts and see if it's in TaxBOT and add it to that if you want. Now, what's interesting about TaxBOT is it's kind of like a BMW. There's more under the hood than it appears. TaxBOT has encrypted backups in multiple high-security data centers. So your data is stored in several different locations in several different cities, all encrypted just like the major banks use. So you don't have to worry about losing your data. You also get powerful reporting. You get all kinds of reports. For example, here you'll see a graph showing how much you're spending on every category. So while you'll be ready for the toughest IRS audit while other people are worrying. In fact, when most people think of an audit like this during tax season, you'll be looking like this, because with one button you can download this to your hard drive, and then you can either copy it to a memory stick for your accountant or email it to your accountant, and they'll get a whole report on every category of expense for your tax return. And we have found that you can do the entire documentation in less, you get this whole peace of mind, in less than 2 minutes a day. You're not going to beat that. In addition to the expense tracker, in addition to the integrated camera, in addition to the mileage tracker with the GPS system, you get me. You get 40 videos on all kinds of topics. You also get over 370 blogs on both tax and financial issues, not just tax. And I talk about a whole bunch of things, from finding nursing homes for parents and evaluating them, what kind of questions to ask, to what are the latest scams in North America, to just enormous number of things. And all of this comes with TaxBOT. By the way, if you Canadians, you get a special deal because some of the blogs may not necessarily apply to you. So we gave you a special deal. You get our entire Tax Advantage of Home-Based Business in Canada as a download, plus the book that comes with it as a download. And that's something special for you Canadians. The point is, by using TaxBOT, you will find more deductions and save thousands of dollars in taxes. In fact, we're so sure about that, we even guarantee it. We want you to try TaxBOT, and just try it, because we guarantee you will save 20 times the monthly cost in the first 30 days alone. What's that? 2,000% rate of return, okay? Or you get your money back. Now, where are you going to get a 2,000% guaranteed rate of return? We're giving that to you. Now, in addition, our customers love TaxBOT. TaxBOT has a 4.5-star rating in the tax store. It is also rated #1 in North America by top 10 reviews among expense tracking software in North America. We have tens of thousands of happy customers. In fact, We are recommended by real estate associations across the country. We are recommended by the National Society of Accountants for their clients, by New York Stock Exchange billion-dollar sales companies. Now, normally, TaxBOT is $19.99 a month for all of this. However, there's a special discount that is available to you. It is half price. This is not something that's going to go up. You get it for half price. So it's only $9.99 a month. And it's not even $9.99. Why not? Because it's tax deductible. So it's only going to cost you about $5.40 a month after taxes. What is that, 18 cents a day for this? I mean, that's a steal. What you do is you simply click on the button. Just click on the button that you see below. In fact, if you want, you can get an even better discount. You can get it for $100 a year and save 2 months, and you still get the same 30-day guarantee. Just click on the button below this screen. And by the way, if you sign up in the next 24 hours, you'll get our premium version, which we charge $159 a year free, which includes our professional services. And here's what the premium version you get. You get to call and ask unlimited tax questions. In addition, you get our Audit 911 service, which will advise you if you get audited. They will also review your last year's return. All this is all for free, all included in TaxBOT, and help you find additional savings. And they have a professional services policy backed by a $1 million insurance policy. This applies to anyone who does this within the next 24 hours. You get all of this free. And in addition to that, still have questions? We're going to be sending you a copy of our ebook after the webinar called Targeted Tax Breaks for Your Home-Based Business. And we have one for the U.S. and one for Canada. Again, it's only $9.99 a month or $100 a year. To take advantage of this offer, click on the link below the screen, and you'll make your life less taxing. Hopefully, I've convinced you of the horrible, horrible mistake of overpaying your taxes, and I apologize to anyone who doesn't take advantage of TaxBOT, because you're going to pay a lot more than those that do. All right, I'm going to turn this back to Jake. If you have any tax questions, please type them in the box, and Jake's going to read me some of the questions that he has received.
Great, Sandy. We have a lot of questions coming in, so we'll try to get as many as we can in this short period of time. First one, my wife uses an Android and I have an iPhone. Can we both use TaxBOT on the same account?
That's a great question. I actually have that situation. I have the iPhone and my wife has a Droid. Yes, one account will work on both separate devices. In fact, you can work it on your iPhone, your iPad, your Droid tablet. It works on multiple devices with the same account. You don't need separate accounts.
Great. Here's another one. Can I write off meals with my spouse if they are my partner in my business?
Good question. Generally, there's a special rule in both U.S. and Canada that meals with a spouse are not deductible. The IRS has what is known, and Canada Revenue Agency has what is known as the closely connected spouse rule. At least they think your spouse is closely connected. Is there any way to write off your spouse? Sure. Remember what I said. Where there's a will, there's a lawyer. IRS and Canada Revenue Agency says whenever you entertain another couple, you may always bring your spouse to keep the other person busy. And how does the IRS know that you're bringing another couple? They look in your tax tracker or tax organizer, and then you can write off the meals for your spouse as well.
Great. We have some people writing in asking if they could go back and put in the first part of this year, put their deductions into TaxBOT. Can you go back and put missed deductions in?
You know, that's one of the best things about TaxBOT. Yes, you can. Your TaxBOT is fully editable and fully customizable, so you can go back to the beginning of the year and input things on the web that you missed. In fact, let's say you didn't have a mileage log. You can actually, if you have your appointment book, you can actually put the where you left from, like say your home, put the address of your home, put the address of where you went. TaxBOT will automatically not only will give you the route, and then let's assume that was not the right route. You can actually take your mouse, adjust the route that you see on there, like a little map, and it will recompute the mileage for you and summarize it for you. So it'll do all of that. It's all editable, and you can do this retroactively in that regard.
Oh, that's awesome. Okay, regarding hiring your kids, is there a minimum age you have to that your kids have to be, and how detailed should their timesheets be?
Good point. The age, generally there is a case on this actually where a doctor hired his kids who are age 7 and the IRS and the doctor won the case and the IRS agreed to the case. So there's a case right now that IRS and Canada Revenue Agency agrees to, which says you can hire your kids as young as age 7. Can they be less than that? I don't know. There's no case on it. But there is a case saying you can hire them as young as age 7. Now, in terms of documentation, your tracker can be used like a timesheet. The timesheet should show what they've done, what they did, the hours they worked, and the time they put in. So you might say, my son Matthew worked on July 2nd, 2013 for 4 hours sorting files. That would be perfect. If you want, you can buy these timesheets. They're available on Amazon or not Amazon, on Costco or Staples. You can get it in places like that. Tax Tracker will work, or you can use TaxBOT for it. But the point is, you have to show, what they did. When you work with family members, you have to dot your I's and cross your T's.
Great. Let's say you go to a business lunch and each of you pay for yourselves. Can you still deduct the meal?
Good question. The answer is yes. You can then take 50%, which is both U.S. and Canada, 50% of your meals, as well as 50% of your friend's meal as well. So, or if you pay for them. If you don't pay for them, just 50% of your meal. You don't have to pay for them.
I have another related question. Let's say I'm at lunch by myself and I start talking to the waitress about my business. Can I write that lunch off?
That's a great question. The answer is no, generally. Generally, showing up and having lunch and talking to the waitress isn't deductible unless, remember I said, it's always an unless, you had a prearranged meeting with the waitress. So let's take an example. Let's say your waitress is your next-door neighbor, and you talk to them about your business, and they go, gee, that sounds interesting. I'd like to make some extra money. And the waitress then says, well, come on to my restaurant during lunch, and we can talk. If in those circumstances where you had a prearranged meeting and you document that in your tracker, then the meal that you have at the time of the lunch would be deductible.
Awesome. Looks like we have a real estate agent on here as well that says they have a regular job and a side business. Can I write, excuse me, that's not the right question. But we do have somebody saying, I have a regular job and a side business. Can I write off the mileage to my job if I am talking to coworkers about that home-based business?
That's a great question. And the answer is no. Generally, going to your regular job is not deductible, even if you talk to your coworkers about the business. That would not be deductible. But there might be a way to deduct a substantial portion of at least one way of the commute. Let's take an example. Let's say you go to your regular job, and on the way home, you stop by a prospect's home for your side business, or you stop by an opportunity meeting. Now, going from the job to the opportunity meeting or prospect would be deductible mileage, and then back home would be deductible. So you might be able to convert that one-way commute and make it deductible by going to a business stop for your side business.
Okay, and then we have a couple more questions. One is, if I sign up for the 24-hour special, do I lock my rate in, or is that like a one-year rate, or does that go up?
That's a great question. You are locking your rate in. We absolutely have no intention of raising the rate. This is not one of these 3-month deals. We have no intention of raising it unless we have, a sudden cost increase like storage or something like that. But other than that, we have no intention of raising the rate. You are locking it in at that rate, at $9.99 a month or $100 a year.
Sounds great. Well, Sandy, that looks like about all the time we have for questions.
One final thing I want to mention. If TaxBOT is not the solution for you, then what will you do? If you don't use TaxBOT, at least do something to protect yourself, because taxes and audits are going to go up. Hopefully I've convinced you of that, especially with a high deficit. Anyway, thank you for your time, and I really hope that I've made your life a lot less taxing.